Here's what you need to understand right now before you make any decisions about the silver market. Forget the obvious headlines for a second. In the West, silver has been trading in the high 80s to low 90s. Reuters reported a record around $86. Fortune saw it around $86.80. Different sources, different numbers, but the same message. Silver is at or near all-time highs in Western markets. That's the story you'll see everywhere. But the real signal, the number that reveals what's actually happening, is coming from the East. Shanghai silver has been priced dramatically higher. One tracker monitoring Asian physical markets showed $104 per ounce. 104, not 88, not 90. This isn't just a small difference. It's a $16 spread between major trading hubs. This is what a two-price world looks like. It's a signal that normal market mechanisms are breaking down. When you see this, you have to stop treating silver like a normal commodity. It's not copper or aluminum. It's behaving like a stress sensor, sitting at the intersection of monetary fear and a real physical bottleneck. Now, for the part that feels wrong, the part causing so much confusion. Historically, when silver has explosive moves higher, mining stocks are supposed to act like leverage. Silver moves up 10%, miners should move up 30, 50, or even more. Why? Because their costs, labor, diesel, electricity, are relatively fixed in the short term. So when the silver price skyrockets, that extra revenue flows straight to their bottom line as profit. That's the leverage thesis. But today, we have something completely different. Silver is ripping, especially in physical markets like Shanghai, and the miners are flat. They are not participating. They're acting like silver hasn't moved at all. So the big question is, why? Why would the leverage play lag when the underlying metal is screaming for attention? There are three honest explanations for this anomaly. Understanding them is the key to figuring out if miners are about to explode higher, or if this is a warning sign. First, let's consider explanation A. The market is afraid of miners. Buying a mining stock isn't the same as buying silver. You're buying a business, a complex company with its own unique risks. You have labor forces that can strike, diesel costs that can spike, and political risks in the countries where they operate. Governments can change tax laws or even nationalize the mines. Plus, there's general stock market risk. Even if silver stays high, a broader market downturn could pull everything down with it. So it's possible that big institutional money is just risk off right now. They're worried about a potential recession or geopolitical instability, so they're avoiding the leverage of mining stocks and sticking to safer assets. If this is the case, the miners might continue to lag until that broader fear subsides. Next is explanation B. Miners always lag at the beginning of a big move. This is a common pattern in almost every major commodity rally. The metal moves first, driven by macro funds and fast-moving traders. The mining stocks catch up later. Sometimes it takes weeks, sometimes even months. Why? Because evaluating a mining stock requires deep fundamental analysis. Investors need to model cash flows, check reserve reports, and assess the management team. That takes time. They need to be sure the higher metal price is sustainable before they revalue the company. But once they do, once the analysts and portfolio managers are convinced, the catch-up move for miners is often violent and explosive, making up for all the lost time. This explanation suggests that all you need is patience. The lag is temporary. Finally, we have explanation C, the spicy one. The one that sounds like a conspiracy until you understand the mechanics, short-term pinning due to options expiration. This isn't some secret plot. It's just market plumbing. It's how derivative markets work, and we have evidence. Let's look at SILJ, the silver miners ETF. It has a massive liquid options market with expiration dates like January 16th, 2026. When a huge number of options contracts are clustered around certain prices, the market makers who sold those options have to hedge their positions. Let me make this simple. Imagine you're holding a beach ball underwater. That beach ball is the mining stocks. It naturally wants to float to the surface because the silver price is high, but you're applying force, holding it down. The higher silver goes, the more buoyant that ball becomes, and the harder you have to work to keep it submerged. Option pinning is like that. It has the mechanical pressure to keep a stock's price near a specific level, usually one where the most options expire worthless, right up until the expiration date. It doesn't require a conspiracy, just a large number of options contracts and professional traders hedging their risk. This pressure can make retail investors feel crazy and shake out the weak hands, but once that expiration date passes, the pressure is released, and that beach ball can shoot to the surface. The options activity on SILJ is very real and observable. This isn't speculation, it's a structural feature of the market. So, what do you think is happening? Are investors too scared of risk? Are the miners just lagging like they always do? Or is this the temporary mechanical pressure of the options market holding them down before an explosive move? The answer will determine everything. Let me know your thoughts in the comments. Higher silver prices don't seem to be benefiting miners, but this isn't proof the thesis is broken. It looks like a combination of mechanics and timing, specifically derivative positioning that's creating temporary pressure. This pressure has a literal expiration date, January 16th. Now, I want you to comment one word to share your take on what's happening. Type PIN if you think this is options and hedging pressure, a mechanical and temporary lag, and you expect a catch-up move after expiry. Or type fear if you believe miners are lagging because the market is genuinely scared. Scared of mining equities, jurisdiction risk, cost inflation, political problems, or something fundamental that won't just disappear when options expire. Before we go any further, a quick disclaimer, and this matters more than ever when markets are moving this violently. This is not financial advice. This is market structure education and macro analysis. I'm documenting an observable disconnect between silver prices and mining equity valuations. I'm not telling you to buy or sell anything, not recommending specific strategies, and not suggesting you buy SILJ or any other stock before or after January 16th. I'm not predicting any specific outcome. Please do your own research and consult qualified professionals before making any investment decisions. What I am doing is explaining the mechanics, showing you observable patterns, and giving you frameworks for interpreting what you see. Let's add some context about why this lag between the metal and the miners creates such psychological pain for investors. It creates so much frustration and temptation to either give up or go all in at exactly the wrong time. When you buy mining stocks during a metal rally, you do it because you believe silver is going higher and you want that leveraged exposure. You have clear expectations. You expect miners to amplify the move. You expect to make more money than you would just holding silver. That's the whole point. It's why you accept the extra risks of equity ownership, jurisdiction risk, operational risk management risk, because you expect leverage on the upside. But when the metal rips and your mining stocks don't move, when silver jumps 10% and your miners are flat or even down, you start questioning everything. You wonder if you made a mistake. You think maybe the leverage thesis is dead. Maybe something has structurally changed and maybe mining stocks just don't work anymore. You might even consider selling everything and just buying silver directly. That psychological torture, that frustration, that doubt, that is exactly when markets tend to turn. It's precisely when the catch-up move often happens, after maximum pain. It happens after enough people have given up, after the weak hands have sold, and after retail investors have capitulated. This is not an accident. This is how markets work. It's how volatility shakes out participants who are right on the direction, but wrong on the timing. So if you're holding miners right now, if you bought them expecting leverage to silver's move and instead they've been dead money or worse, understand that your frustration isn't unique. It's not a sign that you're wrong, and it's not confirmation that the thesis failed. It might just be a sign that you're early, that you're positioned ahead of the mechanical catch-up that historically happens after these periods of compression. Now, let's talk about what happens if I'm wrong. What if the option pinning thesis is incorrect? What if January 16th passes and nothing happens? If miners continue lagging for weeks or months, what would that tell us? It would tell us one of two things. Either the market genuinely fears mining equities for fundamental reasons that persist regardless of metal prices, or silver itself is about to collapse, proving the recent highs were just unsustainable speculation, and the miners are correctly front-running that decline. Both possibilities exist, and both deserve consideration. This is not a guaranteed trade. It's not a sure thing or a promise that miners must go higher. It's a framework, an interpretation of observable patterns, and a thesis about mechanical pressure that has historical precedent but no certainty. The reason I focus on January 16th, the reason that date matters, is that it gives us a clear test, a timeline, a point where we can evaluate whether the mechanical thesis was correct. If miners gap higher in the days after expiry, if we see an explosive catch-up move, the mechanical explanation gets validated. If nothing happens, if miners stay flat or decline, the mechanical explanation was wrong, and we need to reevaluate. Let me give you the historical context that makes this pattern recognizable. This isn't the first time mining stocks have lagged metal prices into options expiration. This pattern has played out repeatedly in gold miners, silver miners, and other commodity equities. Academic research has even documented this option, pinning behavior across multiple markets. It's not some hidden conspiracy, it's just not widely discussed because it can sound manipulative even though it's mechanical. The research shows that stocks with heavy options activity tend to close near specific strike prices on expiration dates far more often than random chance would predict. Settlement values cluster around strikes where open interest is concentrated. This doesn't prove manipulation, it proves that hedging flows affect the underlying prices. The tail sometimes wags the dog. Derivatives markets, despite being smaller in theory, can influence cash market prices through these hedging mechanics. So when you see miners suppressed going into expiration, when you see repeated rejections at certain price levels, when you see behavior that looks more mechanical than fundamental, recognize the pattern. You've seen this movie before, and it often resolves the same way. So what should you do with this information? How should you position yourself? I can't tell you that. I can't recommend specific actions. I can only tell you what the signals are and what they might mean. If you believe the mechanical thesis, if you think miners are temporarily compressed by derivative positioning and expect a catch-up move after expiry, then the implication is clear, even if I can't state it explicitly. If you believe the fundamental fear thesis, if you think miners are correctly pricing in risks that silver's move ignores and you expect the metal to collapse, then the opposite implication follows. And if you're uncertain, if you can't decide which interpretation is correct, then the right move is probably to wait. Watch what happens after January 16th. Let the market reveal which thesis was correct rather than betting ahead of that revelation. Patience is often the hardest trade, but also the most profitable. Waiting for confirmation before you act saves you from being wrong in expensive ways. Let me end with the most important point, the thing that matters more than any specific trade or timing. Understanding market structure, how options affect underlying prices, and how derivative positioning can temporarily overwhelm fundamental value is valuable far beyond this specific situation. This is a framework you can apply repeatedly. It's a lens for interpreting price action that seems illogical, a way of seeing beneath the surface behavior to the mechanical reality. Markets are not perfectly efficient or always rational. They aren't always driven by fundamentals. Sometimes they're driven by plumbing, by the mechanics of how different market participants interact, by hedging flows and margin requirements that create pressure unrelated to underlying value. When you learn to see those forces, when you recognize mechanical compression and understand that price action that feels wrong often is just temporarily wrong, you gain an edge. You gain the ability to position yourself opposite the pressure and the confidence to act when others are paralyzed by confusion. So watch what happens after January 16th. Watch whether miners finally catch up. Watch whether the beach ball, held underwater by mechanical pressure, finally pops to the surface once that pressure is released. And whether this specific instance proves the thesis or disproves it, whether miners rally or not, the framework remains valuable. That understanding of markets as complex systems with multiple simultaneous forces, some fundamental, some mechanical, makes you better at interpreting what you see. It makes you less likely to panic when price action doesn't match your expectations. It makes you more likely to recognize opportunity when market structure creates temporary dislocations. The most painful moments, when your positions aren't working and your thesis seems wrong, are often exactly when you should hold strong, if your analysis is sound and you're positioned ahead of mechanical forces that must eventually resolve. Ever wondered why silver miners sometimes feel like they're stuck in mud, even when silver itself is soaring? Let's break down what's happening and why it could be setting up a massive opportunity. Picture this. As the price of a stock, like the silver miners ETF SILJ, gets closer to certain levels, a whole bunch of options contracts get threatened. These are called strike prices. If SILJ starts to rocket up towards a strike zone where a lot of call options would become profitable, the people who bought those calls are happy. But the institutions that sold those calls, they start to lose money. To protect themselves from huge losses, these institutions have to hedge their positions. How do they do that? They often buy the underlying stock, in this case, shares of SILJ. This buying creates upward pressure on the stock price. It's a feedback loop. Rising prices force more buying, which pushes prices even higher, forcing even more buying. This is what's known as a gamma squeeze, and it can be explosive. Now, if you're one of these big institutions and you want to prevent this explosive rally from happening, what's the simplest defense? You try to keep the price down. You might sell or even short the stock to apply downward pressure, keeping the price pinned below those key strike prices until the options expire. Think of it like holding a beach ball underwater. But what happens when the expiration date passes? After those options, contracts are settled and gone, the incentive to hold that beach ball underwater just disappears. The pressure is released. And that's when you can see a massive catch-up move. Suddenly, miners jump 10 or 15% in a single day, and everyone's scratching their heads asking why. It's not a conspiracy, it's just the mechanics of how options markets work. Here's where it gets really interesting and creates a potential opportunity. Let's say silver is trading in the high 80s or low 90s here in the West, but over in Shanghai, it's being priced at over $100. Meanwhile, the mining stocks are just flat, acting like nothing's happening. This creates a huge gap, a disconnect between the price of the metal and the value of the companies that mine it. In markets, these kinds of gaps usually resolve in one of two ways. Either silver's price falls back down to justify the low miner valuations, or the miners violently snap upward, catching up to where the metal price says they should be. The signals from the physical market, like that huge $16 premium in Shanghai, suggest the second scenario is more likely. It shows that industrial buyers are willing to pay way more for guaranteed physical silver. This makes it more probable that the miners will catch up, rather than silver collapsing. You don't need to be a Wall Street wizard to see this. Here's a quick calculation anyone can do. If SILJ is trading around, say, $30 and silver is at $90, the ratio is about 0.33. Historically, that's low. That's cheap. It's as if miners are priced for a much lower silver price. If that ratio just moves back toward its historical average, miners could double or triple in percentage terms, even if silver's price doesn't move an inch. That's the setup. So why does Shanghai matter so much for silver miners? It's not just a China story. Shanghai is our reality check. It's the truth serum. When industrial buyers in Asia are paying a $16 premium for physical silver, it's a powerful signal. It tells you that access to the physical metal is being valued much higher than the paper price we see on our screens. This isn't just about currency differences. This is industrial necessity overwhelming financial gains. It's a sign that the market is getting tight. And when markets get tight, procurement managers at big manufacturing companies start to worry. They shift from just-in-time inventory to stockpiling. Suddenly, all those bets on lower prices, all those short positions, become incredibly risky. In this kind of environment, miners don't stay asleep forever. They might stay pinned down and frustratingly flat for a while, but eventually, the pressure that's holding them down has to release. So let's talk about the timeline. Why is a date like January 16th, 2026 so important? I'm not saying it's a magic date, but if you look at the options for SILJ, you'll see a massive amount of open interest concentrated around that expiration. It's a logical point for the pressure to be released. Once those contracts are settled, the incentive to keep that beach ball underwater weakens dramatically. That's when we could see a violent catch-up move that seems to come out of nowhere. The catalyst isn't new information. It's the removal of the mechanical force that was holding the price down. Here's a simple 5-point checklist you can use. First, does silver hold its high price or does it collapse? If it stays high, the thesis is intact. Second, does the Shanghai premium persist? If it does, that confirms physical tightness. Third, do miners keep getting smacked down at the same price levels? This suggests mechanical suppression. Fourth, what happens right after that mid-January options expiration? Do we see a sudden move? And fifth, do we see a day where miners jump 10 or 15% while silver is flat? That's the signature snapback. So here are the two main scenarios. Scenario A, the pin holds until expiration. Silver stays strong, the options expire, the pressure releases, and the miners launch into a violent catch-up rally. They reprice in days or weeks, making up for all the lost time. Scenario B, the metal fades. Silver's price drops back down and the miners just stay weak or fall further. This is possible, but that huge premium being paid in Shanghai for physical silver makes this scenario less likely. Here's the key takeaway. If we see high silver prices in the West, an even higher price in Shanghai, and suppressed miner stocks leading into a major options expiration like January 16th, that isn't a sign of failure. It's a sign of a market under immense mechanical pressure. It's a dislocation that smart money sees as unsustainable. The lag we're seeing might just be the quiet before the storm. Thanks for watching, and be sure to follow for more updates.